Hello financial fans, welcome back to another stock analysis. Today we'll be covering Verizon Communications, stock ticker VZ. Verizon is a telecommunication company that provides a wide range of services to both customers and businesses. These services include wireless phone and data plans, home internet, and TV services, and also other business solutions such as networking and cloud services. The company also operates a media division which owns brands such as Yahoo and AOL. Overall, Verizon's main focus is to provide customers with reliable and fast communication services, whether it be through their mobile device at home or for their business needs. They're currently sitting at a $175.6 billion market cap, and in 2021 they generated a revenue of $133.6 billion. Their revenue currently is sitting at a very high 6.15%. 71% from their revenue is generated through services, 21% through equipment, and the remaining 8% through other various income streams. And of their customers, 71% is consumer, 23% are businesses, and 6% is corporate and other consumers. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, financial health, and the growth of the company. And we'll be using a standard margin of safety of 25%, and can either increase or decrease by the ratios that we're going to look at in just a moment. Severity that these ratios will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean 5% increase, orange will once again mean no change, and bright green will mean a 5% deduction. The first 2 ratios that we're going to look at are the EBIT growth and the margin growth. The EBIT has gone up from almost 14 billion in 2012 to 29 billion in 2021, which is a big growth. Over this period of time, the average EBIT growth, however, was 1.35%, seeing as already achieved a growth in 2013 and flattened off during this period, which means a 5% increase in our margin of safety. The margin growth, however, has gone through a very big growth, going from 12% in 2012 to almost 22% in 2021, which is a significant increase. So, 5% deduction from a margin of safety. Next 2 ratios are the dividend growth and the payout ratio. The dividend has gone up in 2013 to 2021, going from $2.12 a share annually to $2.56 a share annually. The average growth in dividend, however, was only 2.4%, which means a 5% increase in our margin of safety. The payout ratio is sitting at a very solid 55.9%, meaning no change in the margin of safety. The final 2 ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and then divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of our debts. In this case, it's very high for Verizon, at almost 4 years, so 400% debt to EBITDA ratio. This means a 5% increase in our margin of safety. The return on invested capital for Verizon is 6.74%, which once again means no change in our margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Verizon. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in cash flow during this period was 22.5%. But since we're calculating the lifetime expected growth of the company's cash flows, I've gone with a conservative 30%, which is still a 6.76% lifetime expected growth in cash flow. Using this percentage, we can determine the future free cash flow of Verizon and determine a terminal year of valuation, using a perpetual growth rate of 3% and a discount rate of 9%. Out of this, we get a sum of free cash flow of 407, almost $408 billion. And to get our equity, all we have to do is add the cash and equivalents and subtract all of their debts, which leaves us with an equity value of almost $232 billion. The last thing we have to do to get our discounted cash flow price per share is divided by the shares outstanding, which for Verizon is 4.2 billion shares. Of this, we get a discounted cash flow model, per share, price per share of $55.47. And with the current price of $41.18, the upside here is $14.29, which is almost a 35% upside. The second model I will be using is the dividend discount model. I've imported the dividend payouts from 4 years ago to the current year. The average growth in dividends here was 2.05%. Since we're again calculating a lifetime expected growth rate in dividends, I've gone with 100% of the growth rate, seeing as every single year they have increased their dividends by 2%. So this seems pretty achievable to me. I will once again be using a discount rate of 9%. Out of this model we get a price per share of $37.62, which with the current price of $41.18 is a $3.56 downside, which is almost a 9% downside. The last model that we'll be using is the multiple valuation. By looking at similar companies to Verizon, looking at their stock price and their earnings per share, we can determine a PE multiple that is average in this industry. In this case, the average PE in the industry is 14.06. And all that's left to do to get our fair value here is multiply it by the earnings per share that Verizon is generating. This is $4.60 per share. Multiplying these, we get a fair value of $64.68. And with again the current price of $41.18, we get an upside here of $23.50, which is a 57% upside. Let's go look at the final overview of our valuation model next. Looking at our final overview, you can see we have imported the discounted cash flow, the discounted dividend, and the multiple valuation price per share. Out of this, we get an average of $52.59. The margin of safety we have determined earlier by using a standard margin of safety of 25%, adding 5% because of the debt to EBITDA, adding another 5% because of the EBIT growth, deducting 5% for the margin growth, and adding another 5% for the dividend growth. Out of this, we're left with a margin of safety of 35% that we'll be applying here to get our fair value of $34.18. And again, with the current price of $41.18, the upside here is a downside of almost 17%. So looking at our model, I consider this a sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.